Eurozone economic growth slows in April as the once dominant service sector struggles to make an impression. The HCOB Eurozone Composite PMI Index compiled by S&P Global fell to 50.4 last month from March's 50.9 reading. Any reading above 50 signifies growth. Another sign that the Eurozone's economic recovery remains fragile was the services reading. It dropped from 51 to 50.1, the worst reading in 5 months. Elliot Hentov is head of macro policy research at State Street Global Advisors. Elliot, what do you make of this set of PMIs? How worrying do you think this data is for policymakers, especially at the ECB? We were expecting cuts, but do you think they might be a bit more aggressive now?
We always expected, I think everybody was expectation that European economy would weaken first before it gets better. And I think a little bit of surprise of how soon and how far it's gone in the weakening process, but it was due to come. And obviously the full impact of the US tariffs are not even in the PMIs that we just saw. So yes, this should give confidence for the ECB to move a tad bit faster than probably what they had expected earlier.
Now, this morning, we got a bit of a shock out of Germany, Europe's largest economy. Its economy, by the way, barely expanded in April, according to that PMI data. But how worrying is it, this political situation we find ourselves with Friedrich Merz failing to get the parliamentary majority he needed to become Chancellor today?
I would not overinterpret the direct implications. So in the short term, I actually do not think that it's that meaningful a signal. Clearly, there's discontent, particularly in the coalition partner, over this government. It's going to be a relatively weak government, but we knew that already. It is a shocker that he didn't pass this formality and didn't jump over the hurdle, but he will eventually, and most of the policy agenda will remain intact. The worry for Germany politically is really long term. Clearly, the labeling of the AfD as an extremist party that the intelligence services are now able to examine is going to be destabilizing for the next electoral cycle. But for now, I would not overinterpret what happened earlier today.
So you're not worried about any changes to fiscal spending plans then going ahead?
Not really. First of all, one has to always be clear that Germany always underspends relative to its allocation. So there is going to be a lot of fiscal coming, but it's going to come slowly. It will disappoint in terms of the timing and pace. And it's really a 2026 story when that fiscal starts to make itself felt.
Now, also this week, we get 2 key central bank decisions, the US and the UK. The US probably the one that most have focus on. So the Fed, we're not expecting a cut here, but we should get some clues on the next moves. But it feels like that they might start to cut rates sooner rather than later.
Well, we've been at the house in the camp of we've expected 3 rate cuts all along this year. We looked quite, let's say, we looked a little bit foolish at the beginning of the year, but we've stuck to our guns, and we now feel like the market has caught up with us. Actually, in fact, the market is forecasting a tiny bit more than what we still think. Clearly, you'll have a stagflationary hit, but that's going to be quite temporary, or dare I say transitory, and then eventually that's going to give the green light for the Fed to embark on a renewed cycle of rate cuts, at least 3 this year.
Now, how worried should the market still be about tariffs, do you think, going ahead?
Tariffs, the reality is, if you're forward-looking and thinking about what's going to drive forward-looking pricing, tariffs are in the past. They are somewhat history, not the trade deals, the trade negotiations, that's still happening, not the transmission of the tariff shock, that's still working its way through the real economy, supply shocks, supply shortfalls, empty shelves, things like that. But from a forward-looking pricing signal for markets, it's in the past. There's other stuff that's going to be meaningful going forward.
And what are those things that you think are going to be meaningful going forward then?
Well, I think the big lesson of April 2025 is the bond market showed that there is limits to what U.S. policy can do. There's a real constraint on U.S. policy making. And if I'm the U.S. administration, I delivered a stagflationary hit to the economy. Politically, I have to deliver something good to the economy, which means I need to have a fiscal package with some sweeteners and some pro-growth policies. But can the U.S. actually afford it, and will the bond market tolerate it? That's the thing to watch over the coming weeks and months.
That was Elliot Hentov from State Street Global Advisors. And don't forget, you can watch more videos on Reuters.com.